What happened to interest rates in the past couple of weeks? They've gone sky high. My name's Evan Kaufman, your VA loan originator, here to help explain some. So a couple of weeks ago, we saw interest rates on mortgages spike. And in fact, if you look at the 10-year Treasury yield, a major indicator for the direction that interest rates head, it spiked the fastest and most furious increase in a 37-year period. Pretty incredible. At first I thought, wow, that was a long time ago. And then I realized, oh my gosh, that was like, I was almost still alive at that point for it too. Some of you watching were alive back then, but it's a long time ago. So in 37 years, we had not seen such a fast spike in increase in rates than we did just a couple of weeks ago. Now what happened? I'm going to walk through a little bit of the economic background as to how that can occur. So over the last couple of months, we saw rates at a high, I should say early in the year in January. We saw rates peaking, hitting a high that they hit a couple of years ago as well when everything was spiking, just going nuts. But then they drifted down slowly. And all of a sudden the election afterwards, everyone's like, okay, hey, we might see things get better. Oh, tariffs. I have a good video on what tariffs and how they can impact rates. Tariffs historically would bring rates down because ultimately increased tariffs would increase people's demand for treasury bond yields and stuff for bonds. It typically would then drive mortgage rates down as well. The whole thing though is that the theory that increased tariffs would ultimately drive people to a more safe investment, being usually the 10-year Treasury yield from the US government, is all predicated on people banking that the 10-year Treasury is the standard safe asset. The issue's been the last couple of weeks that with tariffs, turning them on, turning them off, keeping them on, but giving exceptions to some other folks, has shaken a lot of the trust in investors to what they should purchase as a safe investment. So all of a sudden, some people are questioning, hey, is the 10-year Treasury yield that safe or not? And one issue for us in mortgage then is that I'd say, hey, great, you pick you for it if you think it's safe or not. But the one issue in mortgage is that the 10-year Treasury yield happens to drive mortgage interest rates heavily. So all of a sudden now, we're in a world where the Treasury yield might even look like it's at a similar pace to where things were about a month ago. Not at the high, but not at the low, but in between. But mortgage rates are actually higher than where they were than where the Treasury was. The reason being is people have some uncertainty in what's going on. So, could we see mortgage rates calm down over the coming months? Possibly. The scenario where I see mortgage rates potentially getting calmed down is if we slow down all of the tariff increase and have no major changes on, are we going to add tariffs, take them away or whatnot, and we just had the market steady, have folks get a little more comfortable with where things are at, we could see them naturally settle down a bit. Because again, right now, even though the Treasury yields are similar to where they were a month ago or so, rates are even higher on mortgages because people are just so uncertain. So what it means is investors are demanding a higher amount of money for their capital, which pushes up mortgage interest rates. Or we could see a world where now all of a sudden, hey, if folks really are questioning the 10-year Treasury as a safe investment, or as safe of an investment, I should say, we could see higher rates for longer. That's been a term that's been thrown out there for a long time now, but I do see the implications of that being real if we actually have investors change their mindset from the 10-year Treasury being the standard course of safe investment that it's been for the past many decades. So that's why we're seeing such radical changes, and why over the last couple weeks, if you've happened to been home shopping, you would have went from, okay, not a bad rate, to, ooh, that's a really good rate, to, oh my gosh, what just happened to my interest rate? That's because right now everything's getting moved around due to the tariff situation and then a couple other macroeconomic factors. So keep an eye out over the coming weeks is what happens with all the tariff information, but on top of that, just what happens with general economic news. While typically bad economic news might bring us lower mortgage rates over time, that's not necessarily the case if inflation remains high, because then all of a sudden the Federal Reserve is trying to also fight that as well to keep inflation down. Boy, that was a lot of economic background to it. I studied it. That was my degree. I love economics in a weird way. So thanks for bearing through this with me if you did. But man, I just want to comment on the wild roller coaster ride that we've had with interest rates over the past couple of weeks. Hopefully that helped demystify it a little bit. But just know there's some of us out here that absolutely love understanding how that works and are here to gladly help explain that and talk it through. So feel free to reach out to me. My name's Evan Kaufman. Again, thanks for listening to this. Take care.